welcome. You're watching Talking Point. It's a volatile Friday on D Street. The markets are oscillating between gains and losses, but it seems like a little bit of a base could be made for the day. You're now watching Talking Point, and I'm Samina Nalwala, and of course, we are now going to be talking to our guest for the day, Naveen Chandramohan, founder of ITIS Capital, joins in. Hi, Naveen. Very good morning. Thank you very much for joining us. We're talking to you on a day when the markets have been tumultuous. The last few days have been rough, to say the least. We're off about 1,000 points from our record highs last week. But when you quantify that into percentage, we're only 4% lower than our recent highs made on the Nifty. What I want to understand from you is, with the rising geopolitical stress, how much of that is already in the price, or do you anticipate another 5 to 10% correction from these levels?
So, very good morning to you and all your viewers. Thank you so much for having me. So, as you said, I think we are off the highs, but within that, there is a lot of sector rotation that is currently happening as we speak. So, I think what you're seeing for the first time is while pretty much most fund managers, including myself, are positioned more so from the risk reward, not sacrificing liquidity. The small caps continue to do well. And one of the reasons for that is, from a structural perspective, India is in a position not seen after 15 years, where ROE as an industry is expanding, right? So I think while we can talk about corrections being par for the course from here over the next 6 to 12 months, I think risk management and positioning becomes extremely important. So what do I mean by risk management is, how do you ensure downside is protected during every such fall? Because even today, when your markets are off the highs, you still have power doing well, oil and gas doing well, you still have consumer durables doing well, auto two-wheeler doing well. So end of the day, it's not like every sector is going through volatility. You still have pockets doing well, as a result of which is what I'm talking about, sector rotation going to be increasingly important from here.
I mean, you're right. I mean, at the end of the day, returns are a function of the markets, and the only thing we can really do is manage the risk, and that's pretty much critical. You know, you talked about sector rotation, but I want to talk about market cap rotation. From mid last year towards the end of last year, most people were propagating that the value remains in the large cap space, and that's where portfolio biases should be. But at the first sign of stress, which we've seen in the last 4 to 5 days, large caps that had began a rally have already gotten sold into. Do you feel like a sustainable recovery in large cap names is a far cry, even though they do have a better risk reward at this stage?
Absolutely. So I think it's a great question that you ask, and it's very important to classify large caps, right? Because India large caps is one of the most diversified sectors in the world, with a bias towards banks. Now, if you look at our portfolio, we've been underweight banks for a good part of 4 to 5 quarters, and I continue to maintain that stance. So for us, large caps does not mean bank heavy. Though valuation-wise it looks cheap and reasonable, I still worry about a bit more on the ROA expansion side, and the quality of growth may have a bit more of 2 to 3 quarters to see, especially from an unsecured lending perspective. Where I'm talking about from a large cap perspective is a mix across pharma, non-lending financials predominantly dominated by insurance, power, oil and gas. These are the places where I see sustainability of growth, and that's where we would position ourselves towards. So a broad basing of just moving from small cap to large cap without giving context of how you want to position yourself, I'm not sure is a blanket statement that I would like to make here.
You know, Naveen, correct me if I'm wrong, but you mentioned oil and gas. Let's start with Reliance Industries. The last 4 days, it's been a key contributor to the Nifty's downside. There's a report out by Ambit that says that the growth triggers of its new energy have been delayed. There's delays on monetization. There's delays across the board through its different verticals as well. How do you feel about that? Do you feel like a lot of the good news for RIL is in the price, and the stock hasn't done much, even though it has superior earnings in that sense? That was an RIL question. And also beyond RIL, the oil and gas pack seems to be so sensitive to what's happening to crude prices. Do you feel that stocks like ONGC in All India could continue to gain, but OMCs may once again go back on the sell side?
Sure. So first, coming to Reliance, unfortunately, Reliance, underneath the balance sheet are multiple businesses that is just not oil and gas and energy dependent, right? So you still have the core energy business, which I think should do well. And you still have the telecom business where you will have to take a view on when the demerger is going to happen. Maybe it's going to be 5 to 7 quarters away, but that continues to be a very good cash cow because telecom as a sector is in an upcycle. The issue from Reliance's perspective, what you're talking about where the share price has not done much, comes from the retail business. So end of the day, for you to generate shareholder IRR, you need ROEs to accrete. And retail business has caused a drag on the ROEs for a good part of 2.5, 3 years. So unless and until you see the retail business picking up, you are going to have a drag from a Reliance perspective. So you have two businesses which are actually doing well from a cash flow accretive business. Both of these underlying businesses are growing their cash flows at almost 16.5%, but Reliance Retail is causing a drag on the ROE. So cumulatively, while you see a console level growth of 12%, which for Reliance is higher than mean, there is a drag on one of the core businesses. So that drag has to actually get overcome for you to have an IRR uptick from here. So it's not going to be purely energy dependent, is what I'm saying.
Right. Let's talk about the pharma pack. And I know you're overweight on that because you indicated that to me yesterday. But the overall pharma and healthcare pack seems to be more or less fully priced in for growth opportunities that these sectors offer. I mean, Nifty Pharma Index trades at a PE of 38. How do you feel? Do you feel there's value in the pharma and healthcare pack? And if yes, any specific pockets where you're adding incremental capital to?
So for us, when you look at pharma and you take a slightly zoomed out perspective, right? From 2015 to 2022, you've been in a pharma down cycle specifically driven by US generics. You had not price inflation, but the rate of change of price deflation come down. Predominantly because a lot of the US manufacturers have filed for bankruptcy as US cost of capital has gone up. So the macro is in favor for volume growth to happen for US facing businesses. And many of these businesses have also diversified their product portfolio with an Indian facing ROE accretive businesses. So for us, our portfolio is across generics, it's across businesses with an India facing branded portfolio and CDMO. And we still see a lot of value in these three pockets. So predominantly from a large cap perspective, we have businesses which have diversified US and India portfolio. And in the mid and small cap space, our portfolio positioning is more so towards CDMO pockets. You rightly point out that there is been some level of re-rating in pharma from, let's call it a year back. Many of these businesses used to trade at roughly 40% of the PE that we just spoke about. But as long as growth comes in, but more importantly, margin expansion happens, because some of these businesses that I'm talking about, that net cash to market cap is roughly at 6.5%. And the last time I saw this was around 2014-15. So what you're going to see in the next 2 years is an increased M&A pickup, because the balance sheets are clean, cash accretion is real, and you're going to see M&A pickup. So from here, the quality of M&A in terms of capital allocation is going to decide future returns. So that's where bottom up is going to be important, purely from a capital allocation perspective. But we continue to be bullish, yes.
Across global and local players, your top 2 to 3 bets in the sector, Naveen, at the current juncture and the current valuations, and of course, also ahead of earnings season in the pharma pack?
So, we have roughly 7 names in terms of pharma, amounting to almost 20% of our portfolio. So if, like I said, we are bullish across Indian branded generics, there we have a portfolio exposure in a company called Eris Life Sciences. And in terms of a recovery story, within the CDMO pack, we like Piramal Pharma.
Right. Naveen, when you indicated to me that you're one of the few PMS advisors or fund managers who actually hasn't been too bullish on banks. I had to stand up and take notice. Credit growth for the banking space has been in the range of 13.7 to 13.6% over the last 2 months, and that makes me believe that the earnings downgrade from here is rather limited. But there is a potential for an upside, only because there are large capacities to lend to as well. Do you agree? Do you feel like it's a matter of time and you may turn constructive of banks, or would you avoid banks for now at least?
No, I agree with the entire hypothesis that you laid out. I think the credit growth is likely to be strong from here. What I am not confident of is this credit. So, in the previous cycle between, let's call it pre 21, our financial exposure coming predominantly from banks was on average 40% of our portfolio. So, it's not like we've not been overweight banks in the past. Why we've dropped our banking exposure to as low as 3.5% today is this credit growth is not, according to me, translating into ROA expansion. See, one of the reasons, if you take a step back and we look at Indian banking at a price to book of 2 to 2.1 being cheap versus global benchmarks, is because our ROAs are roughly 2.2 times that of global benchmarks. Now, in an environment where I don't see ROA expansion in an accretive way, what that means is my ROE, which I was used to at 18 to 20%, drops to 16%. And this ROE, unless and until I see it go back to an 18% number, I don't know whether price to book at 2.1 is cheap or not. From a 10-year perspective, it does look cheap, and hence there is value, like you rightly pointed out. But my incremental IRR has to come from an ROA expansion, which is not where I'm confident of. So I'm not saying I'm bearish banking, but from an opportunity cost perspective, I still see there are better pockets of growth. It doesn't mean we will not look at banks, but unless and until I see an environment where I know ROA can accrete, I'm not going to go overweight banks.
You know, what are you doing with power stocks? There's so much changing for the power sector. I mean, in some ways, it's going through a tactical or tectonic shift, right? With renewable energy generation, transmission being prioritized over traditional thermal energy, shorter gestation period, in some ways, better earnings, reduced exposure to coal price. With the likes of a power grid, they're expecting nearly 2 trillion rupees in capital expenditure. So very ambitious plans as well. And while momentum could have taken a hit, fundamentals are still strong. Your top bets in the power pack, and would you play power significantly between now and the next 6 months and keep adding to any sort of adding your allocations if there's any weakness?
Sure. So if I take a 3-year view, right, one sector that I would like to stick my neck out and say that we are bullish on is power. No matter how we look at it, if India has to transition from a slightly more services economy to a manufacturing economy, the backbone of that has to be power. At the same time, if we have to increase our GDP, that has to transition with a power capex expansion. And more importantly, if we believe the data center story is real, and globally, we are going to be talking from a mobile first economy into an AI led economy, there again, you need power. So no matter whether I look at compute, whether I look at manufacturing or a data center led economy, the backbone of all of this is power, which we have been underinvested for a good part of 10 years. Globally, right? And India, one of the reasons we are in a better off position is we never said no to thermal, right? So I think what you're going to see is growth in thermal annualizing at around 12 to 14%, growth in renewables, including nuclear, going much higher at 18 to 24%. But the problem is, today, renewable growth does not mean ROE expansion. So what I would like to play within power is a portfolio mix of a company which has the capability of doing thermal and renewable alongside. So our largest exposure there is in a PSU with NTPC. So that is where I would continue to look at. I would not preferably look at a renewables only player, because you might get incredible top line growth, but I'm not sure that translates into an ROE expansion. So I think I would want to balance out the two. And as you rightly nailed it, in terms of power capex does not incrementally translate into demand accretion unless and until you have the transmission layer sorted out. So the transmission layer legs also has room to expand.
I wish we could chat longer, but one last question before I have to wrap up this conversation. 3 to 4 stocks across sectors, across market cap that is on your watch list, and you would use the next, say, 5 to 10% correction to increase allocation to these stocks.
So more than names, I think I'll lay out the sectors, right? And the way we think about this, mostly we go after market leaders in any of these sectors. So I spoke about non-lending financials. There we continue to be overweight insurance. Insurance continues to be one of that in our top 5. You would see the stock actually figure in. We continue to like pharma. There again, we are incremental buyers. If there is a dip. Then third is auto two-wheeler. There again, we own the market leader. They continue to execute. And fourth, I spoke to you about power. So these are the 4 sectors we continue to be bullish on, and that's where we would continue to add risk at every given opportunity.
Right, exciting. Thank you, Naveen. So good talking to you and getting a perspective from you. Your fund, of course, has beaten the index in the last 1 year and over a longer period of time as well. Then that, of course, means that everything you say, our viewers will be taking very seriously. Thank you, Naveen. Have a great day, and we'll see you soon. Well, the big story over the last few days has been about how FIs have been rebalancing their portfolios and moving allocations or incremental flows into the Chinese and Hong Kong stock markets. Those markets, for good reason, have actually done phenomenally well over the last few days. China, for example, is up 30% in the last 13 trading days, while China as well has had a phenomenal run over the last few days. Well, while you're an investor who's twiddling your thumbs and getting disappointed and worried about the fact that Indian markets are selling off on back of this money moving to China, do not be too disappointed, because as an Indian sitting in India, you can actually diversify your portfolio to make allocations to Chinese stocks. Now let's take you through how you can do it. There are a few ways in which an Indian investor can actually invest in stocks outside a country. First up, you can either do it through mutual funds or you can do it through ETFs. I'm going to start by taking you through which are the ETFs and which are the China-focused funds that you could invest in. Let's start with Edelweiss Greater China Fund. Now, this is a fund that focuses largely and has a major chunk of its investments made in China, Hong Kong, and Taiwan, which is more popularly known as Greater China. This is a fund of funds. So what this fund does is it doesn't invest directly into these markets, but it invests in the JP Morgan Greater China Fund. So it's a fund of fund vehicle where the Edelweiss Greater China Fund is investing in the JP Morgan Fund. The returns of this one have been good. In the last 1 month, it's done about 3%. 3-month return is about 13.5%. And 1-year return is largely what the Nifty has done, with a return of over 20% for China and Hong Kong at a time when those markets have been underperforming. The other way to invest in China and Hong Kong is to do it through ETFs. This is a very popular mechanism. It's a low-cost instrument, and the way you do it is that you buy into the Nippon India ETF Hang Seng Bees. ETF tracks the Hong Kong index pretty much with a very little, with the usual tracking error, so not too much in terms of what Hong Kong does. This is a passive fund, which means that if the Hong Kong index goes up, the Nippon ETF, which invests in this Hong Kong Bees, also goes up. The returns of this one have been pretty solid and in line with what the Hang Seng itself has done. In 1 year, it's done returns of 22%. In 3 months, it's done about 3-odd%. So if you only want to play Hong Kong, which is an ancillary of China, this and through a low-cost liquid instrument, this one becomes a good way to do it. The other one to do is the Mirai Asset NYSE FANG Plus ETF. Now, what this is, it invests in the FANG stocks, which is Facebook and amongst others, the stocks that are listed on the NASDAQ. But what it also does is it has some exposure to Chinese tech companies. So companies like Alibaba and Tencent are present in the NYSE FANG mutual fund. So again, this may not just be China focused, but a small allocation of this fund does make investments into China Chinese and Hong Kong stocks. The returns have been great, but that's not driven by the performance of Chinese stocks. It's been driven by how well the Nasdaq has performed this year. The index, of course, is up about 54%. What you also want to keep in mind is while these are some of the funds that are available and ETFs that are available to invest in the Chinese and Hong Kong stocks, a few other ways to do so is to do this through foreign brokerages. So if you have a Zerodha account and you have a good understanding of Chinese and Hong Kong stocks, you can simply register on these platforms and go out and buy specific companies that are listed in China and Hong Kong. The other way to do this is you can also buy into the New York Stock Exchange. A couple of the Chinese larger tech companies are listed on the New York Stock Exchange, on the Nasdaq and the NYSE. So that's largely how you could make hay while the Chinese markets are witnessing or experiencing or set to experience an outperformance from here on. But a couple of things you want to keep in mind. These funds are high risk. Remember, there is no home bias here. So obviously what happens over there, you are slightly disconnected with. So it might be tough to get a pulse of the market since you're not living in China and Hong Kong. You should consider this as a diversification instrument. So don't go out there and bet the house on these funds, but off your portfolio, talk to your advisor. Maybe a 5 to 8% allocation to Chinese and Hong Kong stocks could be a good idea for now. So those are a few ways of how you can take advantage of the rally that's expected across Chinese and Hong Kong stocks. With that, completely out of time. Thank you for watching.